I need you to stop what you're doing. On December 26, 2025, silver hit $79 per ounce in Shanghai. Not a typo, not clickbait. $79. While New York paper markets pretended the price was $71, physical metal in China traded at an $8 premium. This isn't a chart prediction, or maybe. This is a mathematical fracture in the paper-silver market happening right now. 5 major data points prove the system is breaking in real time. The gap between physical reality and paper promises just became impossible to hide. What you're about to see is the moment when decades of leverage meet finite supply. COMEX registered silver inventories have collapsed. In 2020, the vault held 346 million ounces. Today, roughly 150 million ounces remain. That's a 57% decline in 5 years. But the real crisis happened in the first 4 trading days of December 2025. Over 47.6 million ounces were claimed for physical delivery. That's more than 60% of total registered inventory disappearing in less than a week. Let me explain what registered inventory actually means. This is silver that's physically available for delivery against futures contracts. This is the metal that backs the paper promises. When 60% of the vault vanishes in 4 days, you're not watching normal market activity. You're watching a bank run. The paper-to-physical leverage ratio now stands at approximately 5 to 1. 5 ounces of paper claims exist for every 1 ounce of deliverable metal. Do the math. There are roughly 150,000 open futures contracts on COMEX. Each contract represents 5,000 ounces. That's 750 million ounces of paper claims against 150 million ounces of registered inventory. If just 20% of contract holders demand physical delivery, the system mathematically cannot fulfill those claims. This isn't theoretical risk. This is the moment when fractional reserve commodity trading collides with physical reality. The velocity is accelerating. December 2025 marked the fastest vault drain in COMEX history. Industrial buyers who actually need silver for solar panels, electric vehicles, and electronics stopped accepting cash settlements. They started demanding metal. Investment funds that promised their clients exposure to real silver started standing for delivery. The system worked perfectly for decades because most traders settled in cash rather than demanding actual metal. Banks could create as many silver contracts as they wanted. It's fractional reserve banking applied to commodities. The vault only needs enough metal to satisfy the small percentage who take delivery. But that assumption just broke. When everyone realizes the vault is empty and demands their metal simultaneously, the bank fails. December 2025 is that moment. Confidence in paper silver broke completely. Here's what makes this crisis different from past squeezes. In 1980, the Hunt brothers accumulated physical silver through speculation. Regulators changed the rules and destroyed their position. In 2011, ETF demand drained vaults but eventually stabilized. In 2020, COVID disruptions caused temporary shortages. This time, the demand is structural. The solar industry alone consumed approximately 200 million ounces of silver in 2024, according to the Silver Institute. Electric vehicles added another 90 million ounces. This demand cannot be regulated away. You can't build a solar panel without silver paste for conductivity. You can't manufacture an electric vehicle without silver in the motor contacts and charging systems. The Silver Institute reported 2024 marked the 4th consecutive year of global silver supply deficit. 282 million ounces consumed beyond what was mined and recycled. 4 straight years of deficits have drained above-ground stockpiles to critical levels. This is why vaults are empty. The vault drain isn't happening in isolation. It's being driven by a massive physical demand surge from the world's largest silver consumer. Shanghai silver hit $79 per ounce on December 26, 2025. New York paper markets traded at $71. That take is an 8 per ounce premium for physical metal in China, the largest and most liquid physical silver market on Earth. This premium isn't noise. This is the market screaming that physical metal is worth more than paper promises. China accounts for over 50% of global industrial silver demand. They control approximately 70% of silver processing and refining capacity. When the world's dominant buyer pays $8 more per ounce than the paper price, that's not a temporary dislocation. That's price discovery happening in real time. Chinese silver imports are surging despite weak export demand. Think about what that means. China's economy is slowing. Their export machine is facing tariffs and global headwinds. Yet they are pulling metal from London and COMEX vaults into Shanghai for domestic industrial consumption at an accelerating rate. Shanghai Futures Exchange inventories dropped below 446 tons in December. That's the lowest level since 2016. While Western markets trade paper contracts, China is draining physical metal from global vaults and locking it down domestically. On December 25th, Christmas Day, Chinese silver markets went parabolic. Local prices created persistent premiums over London and COMEX benchmarks. In some cases, Shanghai contracts briefly moved into backwardation. That means immediate delivery was worth more than future delivery. Backwardation is the market screaming physical shortage in the clearest possible language. Normal commodity markets trade in contango. Future prices are higher than spot prices to account for storage and interest costs. When a market flips into backwardation, physical scarcity is so acute that traders pay a premium to get metal right now rather than wait. This is the equivalent of paying extra for next day shipping because you desperately need the product tomorrow. Except we're talking about an industrial commodity that underpins solar panels, electric vehicles, and defense electronics. China isn't exporting silver, they're hoarding it. While Western markets trade worthless paper contracts, China controls the physical supply. This creates a bifurcated market, a China price for physical metal they control, and a world price for everyone else scrambling for scraps. The geopolitical implications are staggering. Silver isn't just a monetary metal anymore, it's a strategic industrial commodity. The U.S. military requires silver for missile guidance systems, radar components, and defense electronics. Solar panel manufacturers need it for conductivity. Electric vehicle makers can't build motors without it. And China is cornering the physical supply while Western markets trade paper. Think about this scenario. You're a U.S. defense contractor with a contract to deliver missile systems. Those missiles require silver components. You've been buying silver futures on COMEX, expecting to take delivery when you need the metal. But when you stand for delivery, COMEX offers you cash settlement instead because there's no physical metal available. Meanwhile, China has the physical silver but isn't selling to foreign buyers. What do you do? How do you fulfill your defense contract? This isn't hypothetical. This is the vulnerability being exposed right now. While China locks down physical supply, the London market is bleeding metal at an alarming rate. London Bullion Market Association vaults are reporting unprecedented physical outflows. Industrial buyers and investment funds are demanding actual metal instead of paper promises. The LBMA has historically operated as the physical settlement hub for global silver trading. When London vaults drain, there's nowhere left to source metal. LBMA lease rates tell the story. The cost to borrow physical silver for short-term delivery has spiked to levels not seen since the 2020 supply disruptions. Rising lease rates signal physical tightness. When metal is scarce, the cost to borrow it for delivery goes vertical. The paper leverage trap is simple math. COMEX has 150,000 open futures contracts. Each contract represents 5,000 ounces. That's 750 million ounces of paper claims against 150 million ounces of registered inventory. London's unallocated silver accounts operate on the same fractional reserve principle. Banks promise delivery of metal they don't physically hold. For years, this worked perfectly. Most traders settled in cash rather than demanding physical delivery. The system breaks the moment everyone realizes the vault is empty and demands their metal simultaneously. December 2025 is that moment. Industrial buyers who actually need silver for solar panels, electric vehicles, and electronics started demanding physical delivery instead of accepting cash settlements. Investment funds that promised their clients exposure to real silver started standing for delivery. The mathematical impossibility of the situation became impossible to hide when delivery demands exceeded available inventory by orders of magnitude. On December 2nd, 2025, the CFTC released its monthly bank participation report. U.S. banks flipped from net short to net long in silver for the first time in recorded history. Banks that manipulated prices downward for decades suddenly capitulated and reversed their positions. They've seen the inventory data and know what's coming. Think about what that means. And for decades, U.S. banks have been net short silver, always, every single month. It was the one constant in precious metals markets, as predictable as gravity. Until December 2025, JP Morgan's history is particularly instructive. In 2020, the bank paid $920 million to settle charges of manipulating precious metals markets through spoofing and other illegal trading practices. According to the Department of Justice, JP Morgan traders placed thousands of fake orders to manipulate prices between 2008 and 2016. Nearly a decade of systematic manipulation. But here's what's fascinating. While JP Morgan was paying fines for manipulating silver prices downward, the bank was simultaneously accumulating physical silver. Industry analysts estimate JP Morgan accumulated somewhere between 600 million and 1 billion ounces during the years they were suppressing prices through their trading desk. They were playing both sides, suppress the price with paper trading, accumulate physical metal at artificially low prices, then exit the short positions when the game is nearly over. When the biggest players in the rigged game suddenly switch sides, you don't ask questions, you pay attention. These banks have access to data and analysis that retail investors will never see. They have trading desks monitoring vault movements in real time. They made the decision to capitulate. The historical precedents for what happens next are clear. In 1979-1980, the Hunt brothers accumulated over 200 million ounces of physical silver, driving prices from $6 to $50 per ounce. COMEX panicked and changed the rules mid-game, implementing emergency position limits that forced liquidation. Silver crashed, and the Hunts were ruined. But the 1980 squeeze was pure speculation. Regulators could change rules and destroy the position. They did exactly that. In 2011, silver spiked from $18 to $49 as ETFs, like SLV, drained physical supply from vaults to meet share creation demand. The 2011 spike proved that when investment demand for physical metal accelerates, paper markets lose control of price discovery. But that squeeze eventually stabilized when ETF inflows slowed. In 2020, COVID supply disruptions caused physical coins and bars to trade at 60% premiums over paper spot prices. Dealers had metal but wouldn't sell at COMEX prices. The paper market became irrelevant for actual transactions. But production resumed and premiums normalized. The lesson from all three events is identical. When physical demand disconnects from paper markets, price discovery fails violently upward. The critical difference in 2025 is that this squeeze is being driven by structural industrial demand that cannot be regulated away. The solar industry alone consumed approximately 200 million ounces of silver in 2024. Electric vehicles added another 90 million ounces. AI data centers, defense electronics, 5G infrastructure, all of it requires silver. 4 straight years of supply deficits have drained above-ground stockpiles to critical levels. This is why vaults are empty. This isn't speculation that regulators can crush with rule changes. This is physics. This is geology. This is the mathematical outcome when annual deficits persist for years and stockpiles run out. Multiple analysts, including mainstream institutions like BNP Paribas, are now projecting $100 silver by mid-2026. Long forecast projects highs of $93, $100 in early 2026, based purely on supply-demand fundamentals. These aren't fringe analysts or gold bug newsletters. These are mainstream financial institutions revising their models to account for the reality of supply deficits. At $100 silver, the 5 major U.S. banks holding short positions would face collective losses exceeding $47 billion. That's not a market correction. That's a systemic failure that threatens the entire derivatives market structure. The $100 tsunami isn't speculation. It's the mathematical outcome when 4 years of supply deficits meet accelerating industrial demand and a paper market that can't deliver physical metal. Every dollar silver rises costs these banks approximately $708 million in collective losses. Silver has already risen roughly $40 from October 2024 levels. That's over $30 billion in realized losses and counting. These banks can't just walk away. They're trapped in a short squeeze. They sold silver they didn't own, promising to deliver it later at lower prices. But prices aren't going lower. They're going vertical. Now these banks have a choice. Buy silver at these stratospheric prices to close their positions, or face delivery demands they cannot fulfill. When the biggest players in the rigged game suddenly flip from net short to net long, as they did in December 2025, you're watching capitulation in real time. They've seen the vault data, they know what's coming. The math is undeniable. Paper silver is over-leveraged, vaults are draining, and physical demand is structural. Your allocation depends on risk tolerance, but 15% in physical silver is the minimum defensive position. Favor physical metal over ETFs and futures. When COMEX settles contracts in cash, paper holders get destroyed while physical premiums soar. Time horizon is 12-36 months. This crisis doesn't resolve quickly when supply deficits are structural. Watch 3 critical indicators: COMEX delivery failures, China import data surging above historical norms, and sudden exchange rule changes. History proves that when the system faces existential threats, regulators protect institutions by changing rules mid-game. The Hunt brothers learned this in 1980. If you're holding paper contracts, when regulators force cash settlement, you'll learn the same lesson. Establish your physical position now before the January 2026 delivery period potentially drains the remaining vault inventory. The window to acquire metal at anywhere near current prices is closing. Not closed, closing. Do not fall for paper price crashes designed to shake out weak hands. If you see a red candle, you laugh and buy physical metal while it's still available.